All right, we got a tale of two retailers today. 30 minutes until the start of cash trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, we're going to talk about that tale of two retailers. Target swings to sales growth as Macy's cut its forecast.
And Ford, once again, reining in its EV spending, canceling plans for a fully electric SUV that may cost the automaker nearly $2 billion.
And markets drifting before data revisions that could wipe away 1 million jobs. That report has the potential to shape the tone of Powell's speech at Jackson Hole. That's coming out at 10 a.m. But let's take a look at where markets are trading about 30 minutes ago until the cash trade begins. You can see we're a little bit higher after ending a little bit lower yesterday. The S&P 500, the NASDAQ 100 up 0.1 to 0.2 pre-market. You take a look at the bond market, all quiet there as well. 10-year yields pretty much unchanged, Matt, but we do have a lot of data points to get through today.
Yeah, as you mentioned, the drop yesterday, not large. The profit taking, not ferocious. Take a look at this chart, and you can see that down at the bottom in this panel is volume. It was the lowest volume for a sell-off so far this year, so not a lot of conviction behind those sales.
Ferocious. I like that, Matt. We're going to talk about another ferocious move here with Ford. One stock we're watching ahead of the open. Investors like Ford here, biting the bullet. Stock up more than 1.5%. The automaker is scrapping plans for an all-electric SUV. It could cost Ford nearly $2 billion. And the car maker is also reducing spending on EVs, Matt.
Yeah, I think investors are very happy to see Ford now spending 30% of its capex on EVs rather than 40% previously. So taking down that spend, obviously they're going to have to take a charge for that. I think $400 million charge and then $1.5 billion of extra costs to move production around. But still something that investors seem to be embracing today.
Yeah, and remember, Ford had forecast that its EV unit would lose as much as $5.5 billion this year. So kind of makes sense that you're seeing that stock reaction. Maybe that number will get a little bit smaller. But of course, as Matt and Sonali mentioned, we're tracking retail results as Target and Macy's diverge. Let's get some more now with Bloomberg's Abigail Doolittle.
A tale of many stories within retail, Katie. And take a look at the shares of Target, absolutely surging up 15.5%. Apparently that Target feeling is back. Now, they beat adjusted earnings, putting up $2.57. That was 18% better. But probably the bigger story beyond that margin, holding on to their margins, is the fact that same-store sales comped up 2% for the first time in 5 quarters, breaking that string of contractions. They also boosted their full-year view, making all of this very interesting. Discretionary spending, very, very strong. Again, that Target feeling. But they lowered the prices on about 5,000 staples, and that was a big draw for consumers to come in, yet maintain the margin. So really a great quarter and outlook for Target. Turning to the shares of TJ Maxx, also we have strength there for that treasure hunt. They boosted their full-year view. Not so much for Macy's, down about 10%. Really pretty ugly here. They took the view lower than what had been anticipated. They're saying it's a very challenging environment, that on the one hand you have their competitors discounting goods, and then on the other hand, consumers really pretty cautious. So this difficult story that we've seen for quite some time for Macy's continuing. And then finally, Walmart. These shares are popping up about 0.7%. They did sell a $3.6 billion stake in JD.com, the Chinese e-commerce seller, down 7.7%, Matt, on this news. This is the worst day of the year, the worst day since October 12th. So lots of interesting stories within the retail space to take a look at today, and also different stories, different tells, yet again, on the state of the consumer.
Yeah, absolutely. Although they're all saying, I think, that the consumer is a little bit more cautious here. Abigail Doolittle, thanks very much for that. Joining us now at the desk is Tony DeSpirito, Global CIO of Fundamental Equities at BlackRock. Tony, great to have you in the building with us. Thanks for coming to visit us on set.
Great to be here.
What do you think about, I mean, all of these reads are a little different, right? Target, obviously, investors are happy to see a return to sales growth. Nonetheless, it looks like even there, consumers are discerning.
Yeah, I think that's the right word. Consumers are more discerning. But when you we have all these individual companies, but really, if you just look at the macro data, retail sales for July, quite positive. And I think that tells a very nice story that the consumer is still healthy. Consumers still have jobs. We're not seeing layoffs. I think the economy is in decent shape.
Is that enough, though, for the benchmark indexes? I mean, I'm looking through your notes. You spend a lot of time talking about the concentration of these indexes, which by and large, I mean, trillions of dollars track them. You think about the tech wobbles that we've seen, even with consumers still healthy, maybe some of that broadening out coming back into the marketplace. Feels like you need tech here.
So a couple of things. One is the wobbles we've seen in the market, I think, are very much technically driven. Whether it was extended positioning going into this, very light volumes, it's August, July, low participation, the yen carry trade breaking down. I think it's very technical oriented. In terms of the market broadening, this is what we've been talking about for some time. We've been expecting more volatility and more breadth in the market. If you look at earnings estimates for the Mag 7 versus the rest of the market, extreme outperformance for Mag 7 in 2023. As we go through 2024, those earnings growth rates start to normalize, and basically they're neck and neck by fourth quarter. I think that's a healthy sign that the market's going to start to broaden.
Tony, something I'm really interested in is when you look at the biggest fund that you're associated with here, actually none of the top 10 names are one of those Mag 7 names. How do you play the broadening here? When you think about the dispersion in the market, where are you placing your biggest bets?
Well, the fund I run, Equity Dividend Fund, is really set up well for this broadening. It's a value fund. And I think one of the things, there's been a lot of ink spilled about the concentration of markets, right? 3 stocks make up 20% of the S&P 500. That's unprecedented. Some of the implications are that the market, the S&P 500, we think of it as a core index. It's really become much more of a growth index. And that's why it has a higher multiple, but that also makes the index more volatile. I think it's really important that investors think about diversifying their portfolios, and the way it diversifies through value. What's interesting is you can't get that done through an index. Even the value index, the Russell 1000 value, has become more growthy and core over time. And so you really need to find an active manager who's stuck to a value discipline.
So how do you do that? I imagine you put together an ETF for that purpose.
We do. We recently launched our first value active ETF, BLCV. And it's really designed to be very accessible, very liquid. We launched that about 1.5 years ago, and it's had great results on
Doesn't value, though, continually head fake? I mean, we keep saying, like, oh, now it's time for value. It's like, active versus passive. It always turns out to be not the case, at least in the past, decade.
Yeah, I was going to say, look at the 50, 100 years of history tells you value investing is quite strong. And actually, I just celebrated my 10th anniversary at BlackRock, and one of the interesting...
Happy anniversary.
Thank you, appreciate that. One of the interesting things I think over my tenure is if you look at the returns to value investing, about 8.5% per year over that 10-year period. Right in line with kind of what you'd expect. What's been abnormal is how well growth stocks have done. And that's part of this whole concentration effect. So it's not that value is done poorly, it's just that growth has done super well over that period of time. History tells you that'll mean revert.
So you got to zoom out, is what you're saying, basically, on the chart. So, of course, the notion of how to avoid value traps, that's a big conversation. But to this idea that when it comes to the benchmarks, maybe they're not the best method of investing here, I want to talk about how that logic applies to small caps, because this is a conversation we've had several times over the past month and a half, that you take a look at the Russell 2000, which a lot of people use to gauge small caps. It's gotten junkier and junkier, that you're getting a lot of zombie companies, so to speak, when you invest in the Russell 2000. So how do you think about the small cap universe?
Yes, so I agree with you totally, right? The valuation gap between large caps and small caps has grown, but so too has the quality gap. 40% of the Russell 2000 is unprofitable companies. Wow, that's unprecedented, right? And so I think what's more interesting than kind of the small cap versus large cap debate is kind of within large caps, it's mega versus large, right? Think about it, we've got these $3 trillion companies, but if you kind of think about a $150 billion company, that's still quite large, still well above mid cap, and yet the opportunity for a $150 billion company to double to $300 billion, that's a lot easier than going from $3 trillion to $6 trillion. So what I think is interesting is sort of run-of-the-mill large cap, and that goes to the point of the broadening of the market. I think that's where the real potential is.
Well, that's what I was wondering, too, whether size is a factor that, you should be paying attention to right now. Or if you're trying to play the broadening, should you be doing it at the sector level within the large cap space?
Yeah, I think the latter is the way to do it. Sector level within the large cap space. If you think about, go back to the Russell 2000, the market cap of the Russell 2000 is equal to one company, the largest company in the S&P 500. Again, unprecedented. It really shows you how this market has really become quite the barbell. I think playing in the center of that market cap, 150 billion or so, is the right place to be.
Tony, we started this conversation about the consumer, the divergence you're seeing, and really we have later in this show at the 10 o'clock hour, those payroll revisions. A lot of people are worried about the economy, the real strength of the economy under the surface. Even those value names, how levered are they to the consumer and any potential recession?
So that's what's interesting. There are a lot of quality defensive companies in the staple sector, in the utility sector, that have been on sale. And so, as the market has risen, 17% or so this year, a lot of defensive companies have been left behind. So value is not necessarily cyclical. And you see that in the equity dividend fund. Our beta is about 0.95, for example. So definitely not cyclical.
I want to just wrap this all up because you talk about, active versus passive or value versus growth. And for the last 10, 15 years, it's been passive. It's been growth. But it's also been, 5% was high for interest rates over the last 10 years, and historically not. Historically, when you see the SOM rule triggered, we're in a recession. Historically, when you see the yield curve inverted, we're headed towards a recession or in one. So is that mean reversion going to happen now? Is now the time for us to get back to normal after this weird, decade and a half that we've had? Yeah,
so I would separate two things, stock market from the economy. So I think the economy post-COVID is definitely very different. And that's why some of these rules like inversion of the yield curve, SOM rule, haven't been working. And what we've seen is a lot of push-pull related to the recovery from COVID that's kind of created almost mini recessions, rolling recessions by sector. We saw that in the tech sector in 2022, today in the housing sector, right? If you look at housing turnover as a percent of housing stock, it's bumping along like all-time historic lows.
Well, but money has been free for a decade, right?
Yes,
and now it's not.
Yes, and so now that's where I think we get back to a more normal stock market, right? Is money is no longer free. Volatility should go back to historic levels, and I would think stock behavior should follow that.
All right, inching our way back to normal. That's a good place to leave it. Tony, great to see you. Hope to see you again soon. That, of course, is Tony DeSpirito of BlackRock. Let's take a quick check on futures right now. We're still camped out with mild gains pre-market. The S&P 500, the NASDAQ 100, both about 0.2% higher pre-market. Small caps leading the way. The Russell 2000 currently up about 0.6%. Now coming up, as investors await Fed clues, we'll speak to Diane Swonk about her expectations ahead of Jackson Hole. This is Bloomberg.
This is high interest to look at what's making headlines around the world. After 2 days of search and rescue efforts, British tech entrepreneur Mike Lynch, his 18-year-old daughter, Morgan Stanley International Chairman Jonathan Bloomer, and 3 others are feared dead. Rescuers believe 6 souls are still aboard the sunken wreckage of the sailing yacht Bazian, located off the coast of Sicily. Troubled LA-based investment firm B. Riley was a self-proclaimed leader in so-called baby bonds for retail investors who wanted bite-sized pieces of debt. In recent years, the firm was selling those bonds for as little as $25 per note. Now, because those securities are low on B. Riley's list of repayment obligations should it go bust, many of those baby bonds have lost half of their value and now yield as much as 50%. Barack and Michelle Obama delivered blistering critiques of Donald Trump while painting Vice President Kamala Harris as heir to their historic political legacy in addresses that capped the second night of the Democratic National Convention.
I want to know Who's going to tell him that the job he's currently seeking might just be one of those black jobs?
But even as the 44th president electrified the crowd gathered in his hometown arena, describing the Harris-Walz campaign as one of joy and hope, he warned the election will be a fight down to the wire. Sonali?
Now, Matt, stocks are edging higher as investors await an annual review of U.S. jobs data as well as Fed meeting minutes for further clues on rate cuts. And joining us now to discuss that path ahead, Diane Swonk, chief economist at KPMG. And you think about how investors have reacted to everything we've seen around the consumer, fairly sanguine, yet a lot of worries about this job market, a lot of worries about those payroll revisions that come out in less than an hour's time. What is your big picture read on kind of the softening here of this economy?
Well, I think what we're really seeing is what the Fed had wanted to see, and that is a consumer that is defiant but not defeated. And in that you see discounting take place, and they show up when discounting takes place. That is what the Fed sought to do with a soft landing. Now, the issue is how far do we get in that process before you start to narrow margins enough? And we did see a narrowing of profit margins in the PPI for the month of July. How do you not get to that edge and see a slowdown in employment that's more of a problem for the U.S. economy? We've already seen the pace of hiring, according to the job openings and labor survey turnover, that has slowed to its lowest level since April 2020. So there's not a lot of room here, even though layoffs are still low, to even accommodate those people entering the labor force without pushing up the unemployment rate, let alone if we were to see a pickup in layoffs. So the good news is the economy's been resilient, but the Fed's job is to keep it there now. And we saw that pivot in Jay Powell's testimony in early July to more evenly weight the full employment side of their mandate with the price stability side of their mandate.
Right, Diane, and that concern really explains why we're also laser focused on these revision prints that are coming at 10 a.m. Certainly the most focused that I can recall in recent memory. But of course, talk to us about that softening labor picture. You have inflation steadily coming down and now closer to the Fed's 2% target than it has been in a while. And you've started to see a lot of people come out and say that the Fed should cut by 50 basis points in September, not so much to ease policy, but just to normalize things. When you think about rates north of 5%, what do you think that they should do in September, and what do you think that they will actually deliver?
Well, what they actually deliver, they get the luxury of not having to forecast themselves and actually reacting to the data as it comes out. They'll be looking at the August employment report. They'll be looking at the August CPI that comes out. Before that, we already know the PCE index from the preliminary data on July is very good as well. So all of that will go into their decision making. I want to see in the minutes today how seriously they talked about a July cut. We know that came up. Chairman Powell made that point at the press conference. And the question was, how serious did they really weigh a July cut? My own view is that if they did a 0.5% cut in September, they could certainly have a dissent. And that would get exactly what they wanted in terms of messaging to the markets, that it was a catch up to July, realizing the economy is ready for it, but it's not a panic reaction. If you have dissents, you can then calibrate what you do in November and December.
It's interesting if you look at expectations, market expectations, Diane, for the next 5 Fed meetings. Previously, the market was looking for cuts at, 2 or 3 or 4. And now the market is expecting cuts at every single one of the next 5 Fed meetings. Is that really necessary with such strong GDP growth, with unemployment at 4.3%, especially if, we slow down immigration, which tightens up the jobs market a little bit?
That's exactly right. And I think, one of the things they're looking about immigration is many of the people who've come to this country will still be entering the labor market over the next 6 months to 12 months. So we're going to have some cushion on that as we move forward, depending on what happens with immigration policy and deportations as well. But I think it is important to understand that, once the Fed starts cutting, its descent in rates, it has sort of advertised that it would like it to be much slower than the ascent. A lot of that depends on how much nonlinearity. You hear the Fed talking about that word all the time. They've always been worried about once the unemployment rate goes up, it tends to go up rapidly. That has so far not been the case, although we did breach the Somm rule. Rules were meant to be broken, as Claudia Somm herself has pointed out, and I agree with her on that. But there is just a question about how far do you want to go on that thin ice, and that's really going to be up to the Fed. But if you've really defeated inflation, normalizing in a reasonable way seems like the thing to do.
Diane, there's a lot of fear-mongering out there about this payrolls revision, and it's interesting. Bloomberg's Cameron Kreis has noted that in 3 decades of Bloomberg data, there has never been a cumulative one-year downward revision of 500,000 jobs or more without a recession. What do these revisions really say to you at the end of the day?
What the revisions tell us is that we actually had much more productivity growth than we acknowledged in the economy. That is actually another reason for the Fed to feel more confident, because it looks like that productivity growth has carried into 2024, and that's helping to dampen inflation as well. And much like the soft landing in the mid-90s, which was very different from this, but productivity growth and intense competition from abroad were helping to keep and doing the heavy lifting for the Fed on rate hikes. I think they need to get back into that view right now.
All right, Diane, always great to speak with you. Really appreciate your time as we count down, of course, to those revisions coming at 10 a.m. That, of course, is Diane Swonk. She is chief economist over at KPMG. This is Bloomberg. All right, it's time now for Social Climbers, the companies making waves this morning. And first up, the AI software developer Big Bear AI getting a boost after news it was part of a team that was awarded a 10-year contract with the FAA worth up to $2.4 billion. Next up, the Japanese tobacco company that makes Winston and Camel cigarettes announcing today that it will buy the Miami-based discount cigarette maker Vector Group for about $2.4 billion to expand its position in the U.S. market. And finally, an Idaho farmer is trading in his Ford F-250 for a Cybertruck. Braden Smith is using the EV to care for his family-owned 2,000-acre potato farm. The farmer and content creator has gone viral for the switch, saying that he saves a lot on fuel. He tells USA Today that when he drives his Tesla Cybertruck around the farm, he either gets a middle finger or a thumbs up. And you can follow all the latest company buzz on TREN Go on your Bloomberg terminal.
All right, let's get a check on futures right now. Just about 4 minutes to go until the cash trade starts. S&P futures and NASDAQ 100 both up about 0.2%. The small caps are leading the way, up about 0.2%. We'll talk with Stephen Wieting, Citi's Global Wealth Chief Investment Strategist and Chief Economist next, because it's not only the stock market we care about, we're also watching very closely these jobs revisions coming out at 10 o'clock. This is Bloomberg. All right, just about 20 seconds to go until the start of the cash trade. This is Bloomberg Open Interest. I'm Matt Miller. Right now, we're seeing a little bit of a gain in futures on the S&P and the NASDAQ 100, about 0.2%. The small caps on the Russell 2000, those futures are gaining a little bit more as we hear the bells ring. Down at the New York Stock Exchange, you've got, I believe, a women's soccer team. I'm not sure which one, but there is a women's soccer team. Chelsea, in fact. Chelsea's women ringing the bell at the New York Stock Exchange. I have no idea why. Take a look over at the NASDAQ. And you've got a black nonprofit ringing the starting bell, the opening bell at the NASDAQ. So with that, let's take a look at where the cash trade is going, where the indexes are moving. In the first seconds of the trade for that, we get over to Katie Greifeld. Katie?
All right, 25 seconds into the U.S. trading day. We have a little bit of a rally on our hands, but I will emphasize a little bit. Of course, after those slight losses that we saw at the close yesterday, slight gains at the open right now. The S&P 500, the NASDAQ 100 up about 0.2%. Small caps leading for right at this moment. The Russell 2000 up about 0.5%. Of course, we are laser focused on earnings. So let's get to Target, jumping after ending a string of sales declines and raising its full year adjusted earnings guidance. TJX also beat. You can see that reflected in the shares. And then at the bottom there you have Macy's lowering its sales forecast, missing estimates, citing increased discounting by competitors. Shares currently off almost 11%, Sonali.
Also, Katie, keeping a left eye here on the housing market. Toll Brothers up more than 2.2% as the market opens. The home builder released results after the bell yesterday, said it's seeing solid demand for luxury homes after that drop you've seen in mortgage rates, Matt.
All right, we're also watching Ford, the automaker, scrapping its plans for a fully electric three-row SUV in a move that may cost nearly $2 billion. But that cut in spending is helping the shares. So it looks like investors are embracing that. Ford canceling some plans as well in terms of, or pushing some back in terms of making trucks. Let's get all the details right now with the man who broke the story. Keith Naughton joins us out of Detroit. So Keith, what do we know about this kind of revamp of Ford's EV strategy, which lowers the cost or percent of CapEx they're actually spending?
Yeah, this is the biggest recalibration of their EV strategy yet, Matt. They are lowering spending on EVs. They canceled this three-row electric SUV, though they may bring it as an extended range electric vehicle, which is the combination of a small gas engine powering the battery. They're adding a commercial van, electric commercial van, and a medium-sized electric pickup truck. All of this is aimed at trying to find the elusive profitability in electric vehicles. They are predicting this year they'll lose as much as $5.5 billion on electric vehicles.
You know, it's pretty fascinating. Matt earlier today was pointing out, along with Dan Curtis, our charts producer, about the margins that Ford has relative to GM and Tesla. Is the cut they're making enough, frankly, when you think about the catch-up that they are going to have to play now to reverse that strategy?
They do have a lot of ground to make up, and they won't say when their EV unit, which they call Model E, will be profitable. But I talked to Ford CEO Jim Farley, and he said the new mantra is that any new electric vehicle must be profitable within its first year on the market. If they can't do that, it won't be approved. That's why they canceled this electric three-row SUV. They couldn't find the profitability. The bigger the electric vehicle, the bigger the battery, which is the most costly component of an electric vehicle. And that's really one of the key things that killed this electric SUV.
So for me, Keith, the bummer is that they're pushing back this new electric truck, fully new design that they're going to build in Tennessee now to 2027. The good news for Ford workers is the three-row electric SUV they were going to build, I believe, in a Canadian plant. They're now going to build their ICE, more of their profitable ICE trucks there. How much of the, we talk about the $5.5 billion they'll lose on EVs this year, the $4.5 billion they lost on EVs last year. How much of that do they make up with the big margin trucks, gas trucks?
Yeah, I mean, that is what finances the company. The big trucks, which really a lot of that falls, as you know, Matt, in their commercial division, which is called Ford Pro, which has become their most profitable unit. But they're making a lot of money on those. They're making money on hybrids, too. So that helps fund the EV plan. But clearly, they don't want to spend as much on EVs anymore because it's a hard business to make a buck in. So that's why they're lowering CapEx on EVs to 30% of CapEx instead of 40%.
All right, Ford shares popping a little bit on that news, but of course still down double digits year to date. Bloomberg's Keith Naughton, really appreciate your reporting this morning. And let's broaden out the conversation now with Stephen Wieting. He is Citi's Global Wealth Chief Investment Strategist and Chief Economist. And of course, we are days away from hearing Jerome Powell speak in the mountains of Jackson Hole. I'm taking a look at the title of your most recent note, Fed Easing, Look Beyond the Obvious. When you look ahead to Jerome Powell at Jackson Hole, what beyond the obvious will they, won't they, of September are you looking to hear about their cutting cycle?
Well, look, they're going to be examining the effectiveness and transmission of monetary policy. There's really no more important question for investors. I don't think it's the words of the chairman. I think everyone has to understand that in the United States, monetary policy goes from restrictive to accommodative. It's never meant to be just static. We have these moments a year in which the funds rate has been at its peak, is historically on the long side. But it's really, again, what has moved in markets, what hasn't. You know, this is the worst kept secret in the world that they would back off from 5.5%. You could take a look at the yield curve has been inverted for a record long 24 months and counting. And yet suddenly you can see in July, August, a massive move in the yen, for example. The foreign exchange market just suddenly caught up with the idea that there was going to be monetary policy convergence. So we should be looking for other things. Let me just give you one. The housing market in the United States, home resales are down about 30% from where we were before COVID, right? So there can actually be a significant impact. There has been a transmission of monetary policy, right? There's a really bad housing market.
But it's going to take a long time, right? I mean, if they cut rates, it's going to make it easier for home buyers to get back into that market, obviously with a lower mortgage, but it's going to take time, right? These retailers that we're worried about, even the ones who do well, like Target, are saying that the consumers are much more discerning. It's going to take time for these lower rates to get to their wallets so they can spend more money, you know, going to Disney parks.
Look, I'm sorry there hasn't been any synchronized collapse in the economy where we can have a wild rebound and everything all at once. That's actually good news. What we've done is we've hidden impacts of recession beneath the surface in an asynchronous economy. Why? Look, the pandemic had a record large decline in services employment. This is not even a cyclical part. It's the biggest part of employment, but it's not something that usually declines in recessions. You know, when you have multi-million recoveries during the exact time where you're feeling the impact of a housing downturn, you kind of hit it all. And, you know, we are in a position now where we're probably not going to get a collapse in aggregate unemployment. We are getting a real slowdown. That's what some of the data will tell us at 10 o'clock. It might be a crawl. But lots of things don't have to happen again. There won't be a new trade downturn. There won't be a new manufacturing and housing downturn. Now, there are some policy concerns, but let's say that's not really going to come from the business cycle.
Let's just double down on the consumers. The housing market is a great example about where you're seeing that pain. You're not seeing it in the big retailers, partially because of that trade down issue. When does the stimulus, when do the excess savings, when do the cash on the sidelines stop mattering because the consumers are feeling too much of a pinch? And you start to see that maybe in Target.
I don't think that the growth rate of retail spending is going to suddenly go from, 4 to 10 again, right? Nominal spending is going to stay here. We're probably going to muddle along. And the business sector has prepared for a downturn that hasn't happened. Right? So that's why last year we had a decline in imports of 13%. Particularly ahead of the U.S. election, I think we're going to pull in all the imports that we possibly can. Manufacturing production was restrained all through this. Take a look at the ISM readings. We're concerned about a recession, and there simply hasn't been one. Well, we'll probably marginally help consumers and will certainly help housing turnover. When we've had such incredibly low levels. So housing-related durables will pick up marginally. It's really the finance, the economics of mortgages and housing that's going to improve on a lower base rate.
And I do like the idea of the, it sounds like you're describing basically a rolling recession.
Exactly.
Yeah, and I mean, I don't envy the Fed for having to make policy around that because it sounds difficult. But like you said, worst kept secret in the world that 5.5% probably isn't appropriate, probably is going to come down. What's the neutral rate? Just to throw you a softball.
Well, that's a softball question. Yeah. So look, I think it's going to depend immigration. We've seen remarkable growth in the labor force from the post-pandemic recovery in immigration. Some of that is unsustainably strong. What is immigration policy for high-skilled and low-skilled workers? What's the speed limit? It's going to be a little bit difficult to tell. The inflation rate has come down very benignly because a big part of this was really the upheaval of the pandemic, not just the stimulus, right? So I think that, we can probably achieve, 2 to 2.5% PC inflation. We'll call it 2.5% CPI here. At interest rates, nominal policy rates around 3.5%.
Stephen Wieting, sticking with us from Citigroup. But we want to bring you some breaking news before we head to break as well. We're taking a look here at Franklin Resources, really dropping here on the day. They said that their Western Asset Management division is having Ken Leach taking immediate leave of absence here to focus on a Securities and Exchange Commission probe. The company said it launched an internal investigation into certain past trade allocations involving Treasury derivatives in select Western asset management accounts. We'll keep an eye on it for you. Stick with us. This is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks right now. We're seeing some slight gains after the slight drops we had yesterday, but basically a resumption, I guess. Is resumption a word?
Yeah, sure.
Yeah, of the March higher that we've seen for 8 of the last 9 sessions. S&P 500 up 0.25%. Russell 2000, those small caps back up almost 0.6%.
Pour one out for those small caps. We're going to get also now those retail results as well, because this is really the story of the day. Macy's slumping after cutting its sales forecast, while Target is reporting strong second quarter sales thanks to price cuts that brought in more price conscious shoppers. You can see the divergence with Target just soaring more than 14%. Macy's down. And it's ex-dividend. And at Macy's down more than 12%. We're going to talk more about Target ex-dividend with Jennifer Bartashis of Bloomberg Intelligence. And we're thinking through just what exactly is helping Target, because you saw the price trade down of a lot of consumers that help Walmart, for example. Target also talking about their loyalty programs. At the end of the day, why are they able to weather this complicated environment for the consumer?
Well, with regards to Target, one of their things is that they're continually focused on what it is that customers need. And so the price cuts that we've talked about have definitely helped because it helps resonate the idea of value with customers. But importantly, they're also in the process of refreshing and replenishing their merchandise and making it compelling at a variety of price points, which is bringing more people back to the categories which Target is most known for. So things like apparel and decor and beauty. So those are things that we're very encouraged by.
Jennifer, also really eager to get your thoughts on another big retail story out today, and that is that Walmart basically selling its $3.6 billion stake in JD.com. Of course, JD.com taking a bit of a bath today on the heels of that news. I mean, what's the logic there for Walmart, that basically they can go it alone in China?
Yeah, I mean, Walmart has had that partnership with JD.com for a long time. And what we're seeing across the consumer space, not just with Walmart, but with others, is a much more tactical approach to the Chinese market. And in the course of the partnership, Walmart has learned a lot from JD.com, particularly with regards to delivery to homes in China. And so I think this is just a reflection of Walmart becoming much more tactical, having acquired a lot of knowledge and understanding of how to run their business themselves, and finding a way to do it the Walmart way.
Jen, thanks so much for joining us. Jennifer Bartashis there of Bloomberg Intelligence, talking to us about the retailers on which we're so focused today, really because of the earnings. Let's talk about your broader stock portfolio, though, with Steve Wieting. He is Citi's Global Wealth Chief Investment Strategist as well as Chief Economist. You just had your Economist hat on for the last block. Let's put your strategist hat on. How do you invest in a situation where, we've come hopefully to the end of this rolling recession, prices have come down, now the Fed's ready to cut? How do you set up your portfolio?
Well, look, we had a 25% drop in U.S. semiconductor shares in early August. That is an opportunity to buy. Closed pretty quickly. We raised our allocation to large caps. In that particular week. We still think, again, that the industry is going to be benefiting from AI spending trends, as well as subsidies, again, particularly the equipment makers for the semiconductor industry. Now, that's a narrow opportunity. Healthcare is cheaply priced relative to the broad market. We're really thinking, again, about broadening, and it's not so much just rotating out of a few mega cap companies. I mean, 3 American companies for a while were the entirety of all of Europe or Asia, but it's just gains in profits are occurring for more companies. We're going to be at a record high profit level this year. We think there'll be a new record high profit level next year. It doesn't mean that the stock market was easy to have a 20% gain. Again, that's the reason why we had room to add.
So this is a market that loves stories. It loves the AI story. That's why you've seen tech go up about a gazillion %. Healthcare, I've had so many people tell me that they like healthcare, that it's cheaply valued, as you say. But what's the story for healthcare? What will ultimately be the catalyst that, the broader investment industry actually takes a look here?
Well, I think if you take a look at some of the things that happened as recently as 2022, tech profits fell, tech shares fell 37% for the NASDAQ. They had a recovery. A broader piece of healthcare equipment and supplies had a downturn over the last 12 months, one that we've never seen before. These are companies that have a 9% dividend growth rate historically over the last few decades. So there's a catching up opportunity there. Probably a lot of worry about policy in the United States. But the reality is people growing older all across the world, moving past just this focus on GLP-1 drugs. The fact is it's going to help a lot of people, again, probably have surgeries that they've been putting off. That this is really a good value dislocation opportunity that's still there. A lot of areas. Again, we're not looking at this now, particularly after the last week. This long period of time, we're not looking at the equity market as deeply depressed. This is not, where we were at the beginning of August, and it certainly wasn't where we were, in early 2020.
Even though you see opportunities in some areas that have sold off, they reflect real worries about the economy, as we've been talking about. Your view on the bifurcated economy, what sectors do you avoid at this juncture? What kinds of stocks do you just not touch?
Well, just not touch for us. I mean, I think that it's really hard to find something that we really hate. I would just say to be really selective among small and mid-cap companies. We want to be careful that this is not Russell 2000, that this isn't been buying submerging companies that were once large caps with a lot of debt. It's buying true growth companies without a lot of leverage. So you can do this by focusing on the growth indices within profitable companies, the S&P indices for small caps.
So that rotation that we saw last month, I mean, if you look at the Russell 2000 last month, it's just stunning, the climb and then the drop, right?
Look, I think that there's, a good deal of false hope in some of these things. This is not a new economic recovery cycle. We are not about to have companies that were on the verge of bankruptcy survive and then their equities double 100%. That's the typical pattern, again, for highly leveraged companies. I mean, one of the things that we said it's not obvious about an easing cycle now is that a lot of leveraged companies are in a good place. Their credit spreads are tight. They don't have a lot of debt to refinance, particularly in 2025. Easing has a marginal benefit for them. But if we take a look at the divergence between growth companies that aren't worth $3 trillion and the rest, there's an unusually large valuation divergence. And many of these companies are going to be a part of the future. The economy is becoming...
So it's value growth, basically.
Yes. Growth at a reasonable price can be found outside of mega cap. Mega cap, I think we can look at them one by one. Our fear for them has been, and again, we've closed and underweight, our fear has been that many of these companies will compete with each other in ways that they haven't before. You could just take a look at the Mag 7. Their business models had completely different areas of demand. I'm not sure that's the way it'll be in the future.
At the top of the hour, in just about 8 minutes from now, we're going to get those payrolls revisions that we've been talking about. Could really change the story a little bit on the day, certainly the week. At the same time, something we've been talking about is positioning in bond markets, just how far traders have gone here, amassing historic levels of risk. Have they gone way too far? Can we see some real pain out there?
Look, I believe that the longer term Treasury yield belongs in the neighborhood of 4%. And yet, if you take a look across the pond in Europe, you can see, similar credits compared to, U.S. sovereign bonds, trading at unusually steeper yield discounts to the United States. The yield opportunity in Europe is 3. The yield opportunity here is 4 for government bonds. And so, okay, I don't think that we've gone to the point where it's terribly troubling. But the bond market did its job here in early August. We had, a solid rally that offset declines in the S&P 500. We got to a richer level, and particularly for the volatile long end of the bond market, we are no longer cheap. We thought we were going into this. I don't think that's the case anymore. Are we really going to get crushed? If you take a look at mortgage rates, we're at twice the spread in mortgage rates over U.S. Treasuries that we've seen historically. We had 8 consecutive quarters of tightening lending standards by banks. If you take a look at structured securities, you're dealing with yields that are so substantially above, for investment grade, sometimes government guaranteed securities, above Treasuries.
All right, Stephen, got to leave it there. Great to spend a nice chunk of time with you this morning. Our thanks, of course, to Citi's Stephen Wieting. This is Bloomberg. This is Bloomberg Open Interest. Let's take a look at markets right now. About 26 minutes into the trade, you can see a rally, a small one, but a rally nonetheless. The S&P 500, the NASDAQ 100 up about 0.3%. Your small caps actually leading the way today, up about 0.6%. Of course, the narrative could shift a little bit at the top of 10 when we get those payroll revision numbers. We'll bring you those figures as soon as we have them. This is Bloomberg.
Stocks continue to rise 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, markets are drifting higher before data revisions that could wipe away 1 million jobs. The report has the potential to shape the tone of Powell's speech at Jackson Hole.
And the Obamas fire up Democrats, but warn of a tough race for Kamala Harris. Agriculture Secretary and former Iowa Governor Tom Vilsack joins us live from Chicago.
And the rise of robots. Serve Robotics teams up with Shake Shack to deploy bots that will deliver your food. We'll speak to the company's CEO later this hour, but let's get a check on these markets right now. That small rally that has been building all morning, getting a little bit more momentum right now. The S&P 500 up about 0.4%. NASDAQ 100, your big tech names, up a little bit more, up about 0.5% right now. Meanwhile, the bond market quiet, but yields starting to pop up a little bit. The 10-year Treasury yield currently higher by about 2 basis points, Sonali.
And fascinating, as we wait for that payroll data, we're going to bring in Michael McKee, Bloomberg's chief international economics and policy correspondent, live from Jackson Hole. And of course, the end of the week is a big moment. But today we do have those Fed minutes. We do have those payrolls, revisions. What are you looking for?
Well, we are not sure at all about how big the payroll revisions will be, because the payroll revisions can be revised themselves, and they will be between now and January. But this is the preliminary estimate, and there is a feeling that we're going to see some significant reductions. The most we've seen in recent years, a little over 500,000 in 2019. So we'll see if we come anywhere close to that. Fed minutes, people are going to watch, obviously, because they want some clues as to whether the Fed is really committed to September or not. I'm not sure whether they'll move markets a lot, because we've got, as you mentioned, Friday, Jay Powell, who's going to tell us, we hope, a little bit more.
Why, if we see such big revisions, and we're keeping our eye out, even if we don't, even if we see, the average, why does the BLS get it wrong to that extent? Why is there such a big margin of error?
Well, one of the reasons is because it's a sample every month. They survey about 400,000 businesses, and they use mathematical and statistical methods to extrapolate, sort of in the same way you do with a political poll, only this is much more scientific and has a much bigger sample. But then they go back and they look in the year prior at what you get from the unemployment rolls, tax rolls from companies, because companies have to pay unemployment taxes on every employee. And so they can benchmark that to a more accurate reading, except for the fact that if you're an undocumented alien and you are working, you don't get counted because they don't pay taxes on them. So that's one of the big discrepancies that people are looking for today, to see if we get a big rise in the number or big decline in the number, and what role immigration may have played.
But even still, these numbers are so backwards looking. Every economic data point we get is backwards looking. But the period that we're talking about here, April 2023 to March 2024, it seems like that's so stale. Will that really inform any policy decisions that they're making next month?
Only to this extent. What the BLS does is basically they take this large number and they apportion it across the prior year, and then you'll start from a lower base. And so it may show that job growth was strong, but not as strong as the Fed thought, and maybe the employment numbers were slowing more than the Fed thought. It's not a crisis. They're not going to change their views on when to change monetary policy, but it might give them more confidence that now's the time to go forward because they have seen lower job growth. Second, there's a political aspect to it. If there's a big job loss, Donald Trump will claim that Joe Biden doesn't know what he's doing. If there's not, then the Biden administration will tout Bidenomics, and so you'll have to kind of put up with that.
You know, as we await that September meeting, let alone Jackson Hole, there is still a lot of economic data ahead, including another payrolls print. And if you think about how much incentive that Jerome Powell has on Friday to really roadmap the road ahead, how much is he really expected to say?
That's the question everybody wants to know the answer to, Sonali. I think what he'll say is pretty much what he has been saying, and that is the numbers that we've gotten have given us more confidence that we can soon start changing policy. But he won't commit to it because they still have a jobs report, a PCE inflation number, and a CPI number coming out before the next Fed meeting on September 18th. So he'll couch it a little bit because he doesn't want to get markets leaning offside if the Fed decides we got some bad numbers and they have to make a different kind of plan. He'll also maybe talk a little bit about some of the lessons learned on monetary policy and how it works on the economy with all the special programs they did during the pandemic, because that's essentially the theme of this conference.
All right, Mike McKee, stay right there. We're going to come back to you when those numbers actually...
Why's he not wearing a cowboy hat?
I don't know, and I think he's on a Zoom camera, so, hopefully we can set that setup up a little bit nicer and find his hat. But Mike McKee, we'll be coming back to you in a couple of minutes when we do get that data. But let's broaden out the conversation now and talk about, of course, Powell's Jackson Hole address and how markets are positioned with a lot of concern over the state of the economy. We're going to do that with Lee Ferridge. He is State Street Global Markets Head of Multi-Asset Strategy. Thrilled that you could be with us. And of course, I think it is really telling that we are all so focused on these payroll revision numbers, definitely more so than we usually are. And what does that say to you about the nervousness out there about how strong this labor market and this broader economy actually is right now, Lee?
Oh, I think we got a hint a couple of weeks ago following the weak payrolls report and the huge market reaction following that, which was a number of factors playing into it, but certainly the catalyst at that time was that very weak payrolls report, triggering of the SARM rule. So everyone's then talking about the US being in recession. We're not in recession. The economy is doing fine. It's slowing for sure. But from a high level, growth in Q2 was strong. It was 3.1% year on year. Look, the economy is slowing down, but it's still growing above trend. And I think the nervousness is very, very high, as you point out. I don't think it's very justified, quite honestly.
Do you think we need to get a rate cut at every one of the next 5 meetings? We've been seeing that priced in, and now people are pricing in 100 basis points of cuts this year alone. Is that necessary in this economy, Lee?
No, it's not, quite honestly. Look, inflation is coming down. That opens the door for them to start normalizing policy, for sure. Do they need to panic? Do they need to go every meeting? No, not when growth is at 3.1%. We had a weak payrolls number. We had one in April. Let's see where we are next month. I think Hurricane Beryl impacted that number. Look at the retail sales data we got last week. Look at jobless claims. Coming back down again. There's a seasonal pattern in jobless claims. It goes up in the summer, then starts to come back down. That's what we're seeing. So, look, the economy is doing just fine. They've achieved Goldilocks right now. So no need for any rash moves, no need for any panic. It looks like they'll do 25 basis points in September. At most, I'd look for one more this year, probably in December of another 25. But they can take their time. Wow. They don't need to rush. They've got room.
Just as irrational, let's say, as the short-term bond market has been, the long-term market has been just as crazy. And you think about November, the elections, and the spending plans from both parties. Do you think investors should be more concerned here about stickier inflation moving forward?
I do. I think that's a risk. I mean, we look at policies from both sides looking into 2025. they're inflationary. On the immigration front, tightening of immigration because of domestic demographics, we need immigration. If we tighten up immigration aggressively, we're going to have a shortage of workers, which will play into wage inflation. Talk of trade tariffs, obviously inflationary. And then fiscal spending. Both sides want to spend fiscally. So there's going to be more stimulus again next year if they get their way. And with inflation still pretty sticky. If you look at Supercore, which the Fed used to want to talk about, in CPI, that's at 4.5% year on year. You look at services inflation, it's 4.9% year on year. Coming down. I'm not saying it's not. But we're not there. We're not at 2%. So economy slowing. They have the opportunity to manufacture that Goldilocks by cutting very slowly, easing back a bit. But they have to keep an eye on these inflation numbers. Not the headline, but the core and then that super core that they said was important before.
Lee, you just said you expect a 25 basis point cut, if I heard you correctly, in September, and then at most another 25 in December. Only 50 basis points of cuts. What does that mean for the S&P 500? What does that mean for the carry trade?
Look, it's not necessarily a bad thing for risk. We've seen this all year. We've taken out rate cuts all year, and equities have done just fine. The carry trade did just fine. The biggest concern for the risk trade, be it equities or carry, is recession. That's what we saw 2 weeks ago. We had the combination of concerns over monetization of AI. We had concerns over the yen, which is the funder for the carry trade. And then we had that payrolls number. And that recession fear was what caused that huge volatility we saw. As jobless claims came out and then retail sales, what happened? Risk came back. We took rate cuts off the table there. We had a lot more in than we even have now. And risk rallied. As long as the Fed don't have to panic cut because growth is slowing aggressively, we can take out rate cuts and risk can hold in fine. That's been the pattern we've had all this year.
Lee, really quickly here, we have less than a minute left, but we've heard a lot of people come out and be vocal about the need for 50 basis point when it comes to September. I mean, Veronica Clark from Citi was on surveillance earlier this morning talking about how the bar is low. Kathy Jones over at Schwab has made the same case, basically that it's not easing, but they need to get out of such restrictive territory. It sounds like that's not an argument that you put a lot of water in.
No, because rates are above neutral, for sure. But if we talk about policy being restrictive, let's talk about the balance sheet at 27% of GDP. Let's talk about fiscal policy with a 6% deficit. Policy overall is not that restrictive. Growth year on year at 3.1% above trend tells us that. There's no need for 50 basis point cuts at this stage. It may be in the future, there will be. There isn't right now, and I think that's the message we'll get from Powell on Friday.
Our thank you to Lee Ferridge of State Street. Of course, a lot ahead. Now, coming up, we're going to talk about the Obamas firing up Democrats at the Democratic National Convention, but warn of a tough race ahead. Highlights from the DNC are up next, and those payrolls as we get it. This is Bloomberg.
We do not need 4 more years of bluster and bumbling and chaos.
A handful of votes in every precinct could decide the winner. There is no other choice than Kamala Harris and Tim Walz.
America's ready for a better story. We are ready for a president, Kamala Harris.
That was Barack Obama along with his wife Michelle at the Democratic National Convention last night. Let's get the latest now from Chicago, where Bloomberg's chief political correspondent Anne-Marie Horton standing by. So they rallied the crowd for sure, and it's a big crowd as well, Anne-Marie, but they also warned this election is going to be a big fight.
Right, and I think that was really the case that Michelle and Barack Obama were trying to make last night. At one point, Barack Obama was talking about some policies, what Trump wants to do when it comes to taxes. Then he was talking about immigration and the fact that one of the most conservative members of Congress, really alluding to James Lankford, the senator for Oklahoma, when it comes to that immigration bill they drafted, how Trump killed it. He said he did so because he wanted the issue for the election. And the crowd started to boo. And then Obama, and he's done this in the past, said, don't boo, vote. Similar message from Michelle Obama. coming out and saying, don't wait for a call from the campaign. It's all hands on deck right now with the shortened timeline to November 5th. And also, we should note, in a swing state like Pennsylvania, voters will start going to the polls just days after the first debate in September with those mail-in ballots. So that was the case they were making in Chicago here. 90 miles from where I'm standing in Milwaukee was where Kamala Harris and Governor Walz, who we're going to hear tonight at the convention center, were making that case in a crucial swing state. They want to make sure they're getting out the votes in these big blue cities in these swing states.
And, of course, the message clear. They're really trying to mobilize the voter base, get them to the polls. You talked about Kamala Harris, of course, not physically there. Let's also talk about what's going on with the Trump campaign. Obviously, a lot of focus this week on the DNC, but what does the counter-programming look like from Trump?
Well, today he'll be in North Carolina, which just yesterday we heard from Kyle Conduct at the Center of Politics, leaning North Carolina was Republican. Now they're saying it is a toss-up. This is interesting, especially since we heard from Barack Obama last night. Barack Obama was the only Democrat in recent memory to be able to carry North Carolina, and he only did so once in 2008. Before that, it never went blue, not since 1976. So the fact that this is toss-up and Trump is there, he is trying to shore up his path to the for 270 in the Electoral College. That's really a must-win for the Republicans. And now it's looking competitive for the Democrats. So Trump will be there today. He's talking about national security. And tomorrow, he's going to be in Arizona on a border tour. So in both of these events for the Trump campaign, the message is going to be, is America more secure abroad and we're more secure at home? Do you feel more secure now? He's trying to tap in to the two issues that he polls well on when you ask voters. And that's one, the economy. We've heard that this week from the Trump campaign, but also immigration. This is one place where voters still think that potentially Trump 2.0 could do better than Kamala Harris. We had Libby Cantrell of PIMCO on earlier in Surveillance, and she talked about two big issues, really. If it's a vibe, personality issue, it's Kamala's to win. But if it's policies, potentially Trump has a path.
Anne-Marie, we thank you so much for your coverage. We're going to stay now on politics. Bring in Tina Fordham, founder of Fordham Global Foresight, joining us now. And the point that Anne-Marie was making most recently here, this idea that Trump on policy, Kamala on personality. If you're at the DNC, you're pretty sold on Kamala Harris and Tim Walz. But what about those swing voters? Is she convincing to them?
Well, I think we need to start out by appreciating the fact that we are in the midst of what is really a huge political experiment for the United States. I mean, one reason why we haven't heard much about Kamala Harris's policies is because she's only been a candidate for a short time, right? She didn't go through the primary process and the kind of meat grinder of that. She's having to introduce herself in a way that isn't typical for a nominating convention like this. The policy detail is starting to come. We saw some blowback from the suggestion of going after companies that engage in so-called price gouging. That's going to be very hard to do. Corporate tax matters to the street, probably matters a lot less to Main Street versus Wall Street. But Harris will be coming out with more detail. I think the short time frame, this compressed time frame really plays to her advantage.
So what is she going to do about the other big issue, or one of the other big issues, which is Israel? Obviously, a lot of Democrats want to see Palestinians get a little bit of relief, but President Biden was a strong Zionist. How does she address this, or does she leave it?
There's not a lot of upside for Harris in coming out hard on any foreign policy positions. She has introduced some daylight between her position and President Biden's in a way that seems to have appeased, the so-called hard left of the Democratic Party. One of the big fears, remember, for the DNC this year was that the pro-Gaza protesters were going to be disruptive. There was a lot of ink about, would this be a replay of 1968? That hasn't happened. I think what Harris is doing, what she needs to do, which is bring together the factions of the Democratic Party. It's a much bigger tent than Republicans are. And, a pretty unwieldy group. And so bringing out all of these big guns, the Obamas, the Hillary Clinton and others, is helping to accomplish that, and Bernie Sanders and AOC.
And of course, you make the good point that there's not a lot of upside for Harris here when it comes to foreign policy and being very vocal there, but someplace where we are getting details of what her policy platforms might look like is when it comes to economic policy, of course, really making a splash when it came to price gouging. There's been talk about price caps, which have certainly turned a lot of heads over when it comes to the coverage there. What do you make of that? I mean, is that what voters want to hear about at this stage of the game?
Listen, they're having to do message testing live, which again is unusual for just a couple of months ahead of a U.S. election. We saw the campaign and Harris herself walk back the remarks on price gouging, again, very hard to implement. There's been some talk that they might start to say something about crypto, and the crypto community has been pretty aligned with former President Trump. There's a lot of space here, but it won't come until after Labor Day. I think we're looking at that first presidential debate between Harris and Trump on September 10th. Between Labor Day and then is when we'll start to see more detail. But there's not a lot of upside, again, for a candidate to show their hand.
Tina, we thank you so very much. That is Tina Fordham, founder and geopolitical strategist of Fordham Global Insight. Now, we are going to keep eyes here on the two-year yield because, of course, it's been strangely volatile this morning. If you take a look at it, we have been on the path lower earlier in the day. Then we were spiking higher on the yield around the 10 a.m. hour. We are back lower on the day as well, but only by about 2 basis points. We are also going to now bring in Bloomberg Michael McKee back with us from Jackson Hole because, of course, a lot of it was contingent on the payrolls data that we had been seeing. You know, what are the expectations here? We want to say that the BLS is reporting now, very late, that the quarterly census of employment and wages data rose 1.3% in the year through March of 2024, according to the Bureau of Labor Statistics. What are you seeing, Mike?
That's all I see at this point. They haven't updated the website for the Bureau of Labor Statistics, and we don't know why. Usually this number comes out within a minute or two of 10 o'clock Eastern, and it didn't so far. We're keeping a close eye on it. But if it is indeed an increase in jobs, that is going to be a big surprise for an awful lot of economists and politicians, because the expectation was we could lose 600,000, and the real pessimists were saying 1 million. Every year, the BLS benchmarks their jobs reports that they put out every month to payroll taxes that the companies pay for workers, and it gives a better, more accurate estimate of how many people were on payrolls, except for the fact it doesn't count migrants. So that's going to be part of the issue is, did we have a number of undocumented migrants who are working but not being counted because the companies don't pay tax on them? So we're keeping a close eye on it. It's just not out yet.
So, Mike, what I'm kind of sussing out here is that the BLS has released some revisions to the way it counts these jobs, but it wants you to do the math. I'm talking to Stuart Paul, who's a Bloomberg intelligence analyst, who says that we're not going to get the final re-benchmarking for months. So we were looking for, you know, an easy number to go by. They've erased 600,000 jobs from the count of last year, or they've erased 1 million jobs from the count of last year. But we're not going to get that, is what I'm understanding today. Is that right?
No, that's not correct. We normally would get a number that tells us how many jobs were created over this period from April of 2023 to March of 2024. But then those numbers are revised again when they get the second quarter figures on this QCEW survey, and they don't apportion it and actually put it into the data until January. So at this point, we're looking for an overall number in terms of how many jobs were gained or lost, but that is a preliminary number, not a final number.
And it's important to note that our colleagues in Bloomberg News have called, they've emailed the BLS. They have not been immediately answered when it comes to an explanation of why we haven't gotten this specific set of preliminary revisions to payrolls that we have all been looking for. But Mike McKee, just give us some context here, because we've been watching the monthly jobs figures come in, you more closely than most, and it's been all about the revisions for months. So give us some context on what the typical range of revisions to the prior month typically is, and what we've seen over the past 6 months or so. How unusual truly is that?
Well, the revisions that we get on a month-by-month basis are based on different criteria. They're based on the fact that the more companies get their numbers in a little later, and so the BLS has more data to work with. This tax-based revision is only done once a year, and it's for prior months. So there's a difference between the two things, but you're right. Everybody is focused on the revisions. Now, historically, this tax-based revision, this once-a-year revision, has suggested both gains and losses. As I mentioned earlier in the show, the biggest number we've seen in a while was 2019, when jobs were revised down by 500,000. Since the pandemic, it's been very difficult to get an accurate read, because we had something like 800,000 jobs returned when the pandemic was over, but that was obviously because of the pandemic.
All right,
So
Mike McKee in Jackson Hole, I'm sure we'll be speaking to you soon. As we await for this data, this is Bloomberg. Well, the next time you order a Shake Shack burger and fries for delivery, what will show up at your door may shock you, if you're in Los Angeles at least. The hamburger chain is partnering with Serve Robotics to use its autonomous delivery robots. The bots are delivering food around Los Angeles in an effort to cut down on road congestion in the Air area. Joining us now is Ali Kashani. He is the CEO of Serve Robotics. I have a lot of questions here, both when it comes to what the vision is, what your ambition is about how big this could go. But to start, I actually have just some logistical questions about how this works, because my understanding is that basically a robot goes to the restaurant puts food in the robot, and then it goes on the sidewalk to apartment buildings. Is that correct?
Pretty much it. From a customer's point of view, it's very much the same. You open Uber Eats, place an order. Today, there's more than 300 restaurants in the area that you can order from. And now Shake Shack is our latest partner. And then you track the robot, it shows up, you press a button on the app, you unlock the bin, and you grab your food.
That is pretty astounding, I have to say. So how far can these robots go? I mean, we're watching one in the video right now crossing a street. It looks like delivering food to a masked man. What's the range?
So the robots can go, all day on a single charge, but usually deliveries are only a couple of miles. So most deliveries in all of United States are like median distance is 2.5 miles. So most deliveries are less than that. So we do today like something around 1 mile per delivery.
I'm really curious also about what your expansion plan looks like, to the point that this is really only available in Los Angeles right now. My understanding is you have a plan and are pretty close here to announcing at least one more market, if not more. Can you bring us under the surface of what those discussions look like? How many markets, how soon, and what are the roadblocks?
Absolutely. We have an agreement with Uber to bring 2,000 robots and deploy them on Uber Eats. The plan is to have them all deployed by the end of next year. The first 250 robots are actually coming online. We are already starting the manufacturing process with Magna International, which is one of the largest tier 1 auto manufacturers. So we will be bringing those into LA next year in Q1. And then in Q2, we are going to launch our second market. And by the end of the year, the remaining of those 2,000 robots would be launched as well.
I'm sorry, I want to go back to the actual robots, because I think this is so fascinating. Because, of course, you have technology, you have sensors that can guide them along the sidewalk, but you have to contend with actual humans and the risk that humans pose. So if someone were to take a bat to one of these robots, which, I wouldn't put it past a lot of people in a major city, can the robots defend themselves? What happens there? Have you seen instances of that happening?
You know, believe it or not, I answer this question more often than it happens. We've had maybe one case in the number of years we've been in LA where someone tried to actually say steal a robot. They ended up in jail. It's not a very good idea. The robots have cameras. They're usually in busy environments. They're not operating at 4 a.m. in a back alley. They're on Hollywood Boulevard, at lunchtime or dinner time. So I think the good analogy for this is mailboxes. I'm sure when they first came, people were worried they're going to put their stuff out there in a box and people can take them. And then after a while, you don't even notice a mailbox. If you go to LA, what surprises you the most is that most people are just so used to the robots that they don't notice them anymore. It's a mailbox on wheels.
Oh, I got to break in here because, I'm sorry, Ali, we do have some breaking news on payrolls. U.S. payrolls have been revised down 818,000. This is a preliminary revision, but the Bureau of Labor and Statistics is coming out with a number that we've been waiting for with bated breath for the last 33 minutes. So it does look like payrolls for the last year have been revised down by 818,000 jobs. Remember, Goldman Sachs, Sonali, you were saying yesterday, had estimated that we'd lose between 600,000 and 1 million jobs, and now it looks like it's really smack in the middle of that.
It is smack in the middle. It is below that high end of the estimate for Goldman Sachs, but JP Morgan expected as low as 360,000. So certainly to some people out there, an alarming number. It is still a large number. The 500,000 would have been fairly historic alone.
Right.
The bond market is moving marginally. We have it 3 basis points lower now, but it was down a little more before.
Yeah, we definitely saw some choppy trading over the past half hour as we were awaiting these figures, of course, from the BLS. They were delayed. And it's important to note this reflects payroll levels in March 2024. So these are backward-looking numbers, more backward than
Forward-looking would be crazy. If they could tell us how many jobs you lost in the next year, that would be nuts.
March 2024, life has changed pretty
AI could do it. You're right.
then.
AI could possibly do it. Mike McKee may be able to make some sense of this data for us. Mike, it does seem like it's in the middle of at least Goldman Sachs estimates. We're looking at jobs, and we have a fantastic chart. I would say let's pull up the chart that we have to show how many jobs were lost in the last year compared with previous years. It's a lot more significant, isn't it?
It is. And we mentioned earlier that the big number of jobs gained in 2022 because of the pandemic ending was one of the records. But this is even bigger than the 501,000 lost in 2019, which was the previous big number. 818,000 works out to about 68,000 per month, and that will be applied to the numbers from April of 2023 to March of 2024. And then you start with a new base level, and we'll see how that affects all of the numbers since then. But basically what it tells us is that the economy on a month-over-month basis, somewhere between 60 and 70,000 jobs lower than what had been reported in each month. Basically, the BLS just apportions it among the 12 months. So it shows that the economy is still healthy and job growth is still strong. It's just that it wasn't as strong as we thought it was. And maybe that gives the Fed additional reason to think, okay, now's the time to cut because we have gotten the job market back into better balance with inflation.
And also sitting to my left, I'm thrilled to say we have Stuart Paul. He is an economist for Bloomberg Economics. He joins us on set. Of course, we previewed this yesterday. Now we finally have the numbers 33 minutes late, but we have them nonetheless. What is your initial reaction here? How does this affect your thinking about how you've been taking in the U.S. market?
Most of the downward revisions are in some of the more cyclically sensitive sectors. We're talking leisure and hospitality, manufacturing, professional and business services. So these downward revisions are mostly concentrated in a lot of, again, cyclically sensitive industries, interest rate sensitive industries, the industries that the Fed has been looking for as some sort of an indication of the resilience of the labor market. And when we see basically 818,000 jobs that folks thought had been added into the labor market actually revised out, the Fed's going to be taking note of this as we head into the September FOMC meeting.
You think about what we saw today versus what we've seen historically as well, and the number feels and looks large. It certainly is relative to what we've seen before. How was it this off? I mean, at the end of the day, $800,000, what really changes about the narrative?
So the thing that, one of the reasons why this is such a meaningful revision is because a lot of payrolls are inferred based on a relatively narrow survey of businesses. The Bureau of Labor Statistics then estimates how many jobs were actually created on the assumption that businesses are born, businesses die, they add jobs when they're born, workers get laid off when those businesses close. And that model has been pretty dramatically off. And we can see that based on bankruptcy filings. As we look at bankruptcy filings, which have been increasing, it doesn't really comport with what we've been seeing from the model operating in the background of the Bureau of Labor Statistics. So we would expect the numbers to be off. This off is pretty dramatic. It's the largest that we've seen in 15, 16 years. It's about 1.5 times larger than any other downward revision that we've seen. So it's a pretty big deal.
I know we want to talk about the credibility of the BLS. Before we get to that, I want to just point out that we've seen stocks rise to session highs. You've seen yields jump as well. Mike McKee is out at Jackson Hole, where we're going to hear from in a couple of days Fed Chair Jerome Powell. Mike, I've got an investor writing in saying, dismiss the revisions at your peril. Given what we know about the pace since March, it seems likely that those more recent jobs numbers were overestimated as well. Does this push the Fed closer to maybe even cutting by 50 basis points when we see them meet in September?
No, I think it's probably, Matt, going to have more influence on the fact that they will cut in September rather than an amount, because remember, we still have more jobs reports and more inflation numbers coming out before then. So those will be more dispositive for the Fed in terms of how much it decides to cut. And when you look back at these numbers, it's about 68,000 a month, as I mentioned. That takes the average for that 12-month period down to 174,000 jobs from 242,000. It's still a very healthy number of jobs. You're looking at 100,000 maybe if you want to just have a replacement level or, to absorb new entrants into the workforce. So the Fed probably wouldn't have changed policies at all during this time period either with 174,000 average. So I don't think we get any kind of signal that they're going to go 50 for any reason.
And of course, a good sort of break check there that we do have another jobs report before the September Fed meeting, jobs figures that we will take with a massive grain of salt, because just to read this headline again, U.S. payrolls likely to be 818,000 lower in the year through March than previously reported. And Stuart, we have to talk about credibility here when it comes to the BLS, because we've been watching this pattern unfold for months now. Does this call into question the credibility?
To some extent, I think everybody in markets has been acutely aware that on a monthly basis, and we discussed this yesterday, some of the numbers get revised pretty dramatically, as much as by half, and we see that every month. So a lot of attention has been given to the birth-death model that's been in the background of all the initial estimates of payrolls. So it's going to take a concerted effort to at least communicate updated efforts or additional efforts to improve their estimates on a monthly basis. To Mike's point, though, and I think that this is important, there is still hiring above what would be associated with a typical expanding labor market or a stable unemployment rate. So the question is, why have we seen the unemployment rate continuing to rise? Part of that is immigration. So the difference between
expanding labor market, we're getting more supply.
That's right. So the difference between, say, 225,000 jobs added per month and 165 or 170,000 jobs added per month is a big deal, and it helps to reconcile what we've seen in the establishment survey, or what we should see with the final re-benchmarking, with what we get with the unemployment
How
rate.
big is that expansion? Do you have your arms around it? Because I think the foreign-born labor supply was up 11% last I looked. Obviously, Donald Trump talks about, illegal aliens in the numbers of like 15 million. How big is this expansion from people coming across the border, either legally or illegally?
Estimates vary for total immigration to over the past several years. It's not quite an order of magnitude, but it's the difference between 10 million and 30 million. So it's just such a wide band that it's difficult to see. What we do look at on a monthly basis is the share of unemployed folks who, and the share of flows into the labor market from foreign-born and native-born. One of the things that's difficult, though, is that survey response rates are going to vary based on one's immigration status. So it's really difficult to pin down the precise number from a census perspective and from a labor market perspective.
Stuart, we thank you so very much for your time. That is Stuart Paul of Bloomberg Economics, and Michael McKee over in Jackson Hole. Of course, don't miss his coverage throughout the week. Now, coming up, we're going to talk about the Obamas charging up Democrats in Chicago as they head into day 3 of the DNC. We're going to speak to U.S. Agriculture Secretary and former Iowa Governor Tom Vilsack, who is there next. This is Bloomberg.
All right, we are on day 3 of the DNC. Minnesota Governor Tim Walz will headline tonight's convention. He is expected to officially accept the vice presidential nomination. Joining us now from Chicago is, I think it's fair to say, a good friend of his, Tom Vilsack. Tom is speaking to Bloomberg Open Interest in a personal capacity as the former governor of Iowa, rather than in his current role as Secretary of Agriculture. But I want to ask you first and foremost, Mr. Secretary, about these labor numbers. We got a drop in job creation of 818,000 in the year through March. And I wonder what would happen if we got even a lower job number coming forward. You know, we hear the Republicans talk about a cut in immigration. They're also talking about more spending, lower taxes, and increased tariffs. Isn't that all inflationary?
Well, certainly when you shrink the supply of anything, it obviously has an impact on the price or the value of that thing, whether it's labor or whether it's goods and services. So I would anticipate and expect that folks would end up paying more for whatever it is the supply is being shrunk. So if it's labor supply, if it's goods, you're going to see higher prices. I think it's been suggested that the tariffs that former President Trump is suggesting would increase the cost to the average American family of about $3,800 a year. So that's an indication of the impact and significance of some of the policies that are being discussed in this presidential election.
Well, they also want to, I mean, if you saw the Republican National Convention, everybody holding up these signs, mass deportations. They want to get rid of, I think Trump has said, 15 million people from this country who may not have papers, right? They may be illegal immigrants, but a lot of them are working in jobs. And what happens to the labor force if you take that many people out of the picture?
Well, I think a better idea would have been for President Trump to lift his advice and command to the Republican Senate and House not to pass the toughest immigration reform bill that had been proposed, that was prepared for passage based on a bipartisan vote. That was the solution. That was the opportunity for us to solve this problem. And it's unfortunate that politics interfered and that President Trump believed it was more important to help his campaign than the country. So I think that's where you start. You don't start with mass deportations. You start with fixing the system. And you fix the system based on what I think was a very solid plan that was negotiated in good faith between Republicans and Democrats.
Well, let's keep talking politics, and let's talk specifically about the election and, of course, the DNC. And Kamala Harris picking Tim Walz, of course, the governor of Minnesota, as her running mate. Do you think that that will be enough to make states such as Iowa actually competitive for Democrats? And if so, I mean, what will it actually take?
Well, I would say that Governor Walz is someone that you can put into any room in any community in any part of the country, and he would be able to relate to the people in that room, which means that he can be a very powerful spokesperson for rural America, for the small towns and rural places in the country that oftentimes don't get the level of attention that they deserve. He understands that. I think that's why he's been successful. You know, he won a very conservative district in Congress in the state of Minnesota. He obviously was elected and re-elected governor. So he knows how to basically convey messages and policies in a way that people understand and appreciate and respect. So I think he's going to have an impact and effect on the opportunity to attract Democratic votes in rural communities and small towns across a number of key states. Obviously, Minnesota, Wisconsin, Michigan, Pennsylvania, the key states in this race, Arizona, Nevada. This is a guy who can talk rural. And I think that really matters. And I think it's a reflection of the decision and the difference in decision making between Vice President Harris's choice and President Trump's choice. Obviously, Senator Vance can speak to a specific very well-defined constituency, doesn't have as much of the broad appeal, in my view, as Governor Walz.
Tom, I'm curious about your view here on Iowa. It has been a battleground. It has been leaning red. And at the end of the day, is Iowa gone for the Democrats? What would it take for the Democrats, the Harris-Walz ticket, to win it back?
Well, I was the first Democratic governor elected in 30 years in Iowa in 1998, so we've been down this path before. And what it takes is winning. And I think Iowa actually in this cycle has a tremendous opportunity. There are a number of congressional districts that are very competitive in Iowa this year. And I think it's reflected in the amount of resource and investment that the House of Representatives on both the Republican and Democratic side are putting into Iowa and into Iowa candidates. So I think success this year, and I think the Harris-Walz team basically has given us a jolt of energy and enthusiasm that's going to allow us, I think, to deliver the vote for these congressional candidates with a couple of wins. Then the whole dynamic changes. And then, of course, we've got a key governor's race coming up in a couple of years. So I think the table's set, and I think these congressional races are critically important.
I think we saw farmers' net income fall something like 25% last year. Obviously, crop prices have been a real problem. Don't farmers need to make more money? Is there a way that the Harris-Walz ticket can help that happen?
Well, I got to be careful about this because I can't, because of the Hatch Act, I can't really talk about what I'm doing or what we're doing or what could be done in the Department of Agriculture. Let me just simply say this. The 3 years of the first 3 years of the Biden-Harris administration, 21, 22, and 23, cumulatively best farm income in the last 50 years and arguably ever. In fact, 2022 was a record year. And the reality is it's similar to Aaron Judge. If he hits 62 homers one year and hits 40 homers the next year, has he had a bad year? Not really. He's had a pretty good year. He just had a record year the year before. And I think the key here is for us to continue to look for ways in which we can generate, whether it's farming or whether it's any business for that matter, additional revenue streams, diversifying and diversification of revenue streams so that you're not overly dependent on one aspect of your business to be able to prosper. And I think there are opportunities that have been created by the American Rescue Plan, the Infrastructure Law, and the Inflation Reduction Act. Investments, by the way, which will carry on for years to come to be able to help build out opportunity both in agriculture and in other industries that impact rural folks in particular.
Well, when it comes to these rural districts and rural voters in particular, how important do you think that boosting farmers' incomes will be? Whether or not, of course, it has to do with the current administration's policies, voters tend to look at how they're feeling right now under the current administration, and that informs their next vote. So do you see boosting farmers' incomes as key to maybe putting some of these rural districts back in play for the Democratic Party?
Well, you know, the old saying is if farmers do well, the entire community does well. And I would say that's very, very true in many, many rural areas across the country. So obviously, it is important. But what I think the important goal here is to make sure that the rural economy is robust enough that it has a substantial number of new opportunities. The administration, this administration, the Biden-Harris administration, has invested a great deal in clean energy, just to give you an example. And the clean economy. This opens up a whole new set of opportunities in rural places that can impact and affect farm income, but also can help create jobs, manufacturing jobs, processing jobs. The whole idea of creating more competition and more opportunity within agriculture and other industries, critically important. Because it creates new opportunities, it creates new construction jobs, it creates new jobs in those manufacturing and processing facilities, all of which relate to a more vibrant rural economy, which obviously impacts and affects people's attitudes and sentiments. So people are beginning to see infrastructure being improved. You know, President Trump talked a lot about infrastructure when he was president. He never got it done. The Biden-Harris administration is getting it done, and we're going to continue to see roads and bridges and rail systems and ports and lock and dam systems, all of which impact and affect in a positive way business opportunity in rural communities.
Well, we have to leave it there, but we really appreciate you taking time out this morning to speak with us. That, of course, is U.S. Agriculture Secretary and former Iowa Governor Tom Vilsack. Meanwhile, let's get a check on these markets because it's been a busy day. The S&P 500, it had been up about 0.5%. Now we're back to unchanged on the S&P 500 and the NASDAQ 100. Of course, we did finally get those U.S. payroll revisions, and certainly it was a big one.
Yeah, absolutely. Looks like so 818,000 breaks down to more than 60,000 jobs less per month in the last year. It basically means the jobs market was far weaker than we thought it was for the past 12 months, or at least through March. And the question is, has it been weaker in the months leading up to Jackson Hole? Because maybe the Fed needs to think about cutting a little bit more.
A lot of this was baked in. The 2-year yield down 4 basis points off the heels of 8 basis points yesterday. So when you take the 2-day move, significant. Not much changing in Fed swaps for cut expectations, though, guys. Now, coming up tomorrow on Open Interest, we're going to talk to Crunch Fitness CEO Jim Rowley joining us in the C-suite. Stick with us through the week. We're going to bring you the macro to the micro and everything in the lead up to Jackson Hole. This is Bloomberg.